Good afternoon. My name is Robert Rayburn. It is October 16th of 2023. And without further delay, let's get to work. I know it's been a long week. We had the horrific attacks that took place in Israel. In fact, the last time we made that recording was the day before those attacks took place. So certainly we want to take this moment to extend our condolences to all of the victims of the attack that took place last Saturday or 2 Saturdays ago, and there's never any excuse for it. It was a crime, and it was horrifying in terms of what happened. And I certainly could never imagine anything like that happening to anyone I know, and certainly my family. And it's unfortunate that we live in a world like that. But without further ado, let's get started. And the impacts of that event as it relates to the market are things that we're going to want to review for the week. And rightfully, this is what our presentation is called this week. When we look at, how does war impact stocks? It's something that we spent a lot of time on when the Ukraine war started out. And how do geopolitical events impact how we look at investing? And if you look throughout the course of history, geopolitics creates a lot of noise, right? Because there's no more carnal event that takes place as humans than war, right? It's a life and death struggle during these conflicts, and it elicits a lot of emotion. But sometimes when it comes to effective investing and understanding how to deploy capital, we have to take, and it's really hard, an unemotional approach to how we look at things. And we know these events are going to happen every couple of years, especially being here in the US, the country that is the global policeman, for better or worse. And these events have an impact. That said, whether or not McDonald's is successful, whether or not Google continues to make money in search, those are separate events, and we want to be mindful of, how do events impact market sentiment in the short term, but more importantly, how are businesses going to adjust to the underlying environment? And that's our job as investors. So 3 big things from this week is, what does the war in Israel mean for stocks, short and long term? Number 2, a stock market correction update. We're still in the midst of an ongoing stock market correction. Where are we in that process? It's been a long grind. Number 3, how did energy respond to the big correction that sector experienced, not last week, but the week prior? And what does that say about the state of the energy bull market? So to really understand the Israel-Palestinian war, I think is to try not to understand it at all, right? We're not geopolitical experts. We're fairly well read on the topics, but I don't think anyone is a real expert. Otherwise, you would be able to solve this conflict. This is a conflict that's been going on for hundreds, if not thousands, of years, and this is a conflict that will probably continue for many, many more years. But what we can do is say, when there are more intense flare-ups in this part of the world, how can we protect our portfolio from potential knock-on effects? What are areas that are going to benefit regardless of what happens, right? So when we think of the world right now, there's 3 big challenges that are taking place. War and politics. The Middle East is a combustible area, and we're seeing the results of that today. We're also dealing with inflation and high interest rates. On the opposite end, we're dealing with these larger movements of growing emerging market demand for goods and commodities. And that's through the emergence of India as that next global powerhouse. And China, while slowing down, still a massive consumer of resources. And then, of course, that other part of it, U.S. reshoring, as U.S. and China continue to evolve their relationship into more strategic competitors on the world stage. The U.S. is continuing to reshore industrial capacity and manufacturing here in the United States. How does all of that impact? So when we're looking at these 3 things, we have to ask ourselves, what is one common denominator that can work in all three? And there's one sector in particular that we find works no matter what happens, and that's energy, right? In war in the Middle East, if Iran gets involved, if Iran is found to be complicit in the terrorist attacks that took place against Israel, the act of war that took place against Israel, then certainly Iranian barrels are going to come off the market as the U.S. cracks down on that. And worse, U.S., Iran, or Hezbollah get involved in a conflict in northern Israel, southern Lebanon. That certainly will have an increased impact on energy markets across the world. If we think of interest rates and inflation, we know from a quantitative perspective that when inflation increases and interest rates go up, energy has a tendency to outperform because it has pricing power. Number three, EM demand increase in U.S. reshoring is increasing the amount of demand for barrels of oil, right? So as Indian consumers continue to increase their demand and consume more, they're consuming more oil. Same with China, same with the US as that manufacturing capacity comes over to the US. This is a big reason why energy is one of our big themes, not just for this year, but for the next few years. Then we get into green energy policy and the knock-on effects that has. So overall, we really like energy in this geopolitical setup as it relates to rising rates, rising inflation, and the U.S. reshoring that is taking place. And of course, the emergence of India as a superpower. So, as opposed to trying to guess the direction of the market as it relates to war and politics, what are the areas of the market that can benefit? And I think that's the approach that we want to take as investors. Now, as it relates to the stock market correction, we continue to trudge through this channel, right? This downward channel that we've been in since late July. We got the support here. One of the things that we mentioned last week and the week before is market was pretty oversold. We were expecting a bounce, and we were very specific. We're expecting a bounce within an ongoing correction. And now we're starting to approach resistance at around 44.15. So, what we're doing right now is we're really trying to avoid areas of declining relative strength, whether it's within technology, whether it's within the broader market, such as utilities, consumer staples, financials. These are areas where relative strength and breadth continue to narrow and decline. So we want to avoid those areas. We want to focus on the areas of where we are seeing dominant bull trends intact, buyable dips, right? Like we saw energy pull back about a week and a half ago. That was a buyable dip, and we're going to show those charts later, right? The panic that the energy bull market might be over. Well, guess what? Last week kind of disproved that, at least in the short term. That would prove to be a buyable dip. Those energy stocks look way more attractive than oil itself. That's what you want to see as a trader. That's what you want to see as an investor, that the stocks lead the commodity, right? So we're trying to use those pullbacks to shop for stocks with improving relative strength scores and that are in dominant long-term bull trends. That's how we look at the world. The other thing that we're mindful of is that the bounce over the last week in the broader market, outside of the stocks that we own, of course, has been fairly weak. So when markets bottom, and whether it's a correction or off a bear market, you want to see super high volume, almost like there's a panic to buy stocks. Huge amounts of volume as people are covering their shorts and going long. There's just people are falling over themselves to buy stock. We didn't see that over the last week and a half. We saw very tepid volume, as we can see here. These small bars here, that's the volume upside on this bounce. But notice what happened when the market declined in the latter part of last week. Massive volume, right? Lots of volume and very significant negative breadth. Declining stocks of negative 6.6 to 1 versus very shallow positive breadth on those up days. So that kind of gives us a clue that, hey, maybe this correction isn't quite over yet. And we want to be careful while chasing those areas that are at the center of the correction. The other thing we'll say is it's been about 1 year since the market bottomed off the 2022 bear market, and animal spirits remain missing, right? So, a few things when a bear market makes a bottom, a true bottom, you usually get a few things that really outperform. Small caps, commodities, technology, and industrials, and of course the banks. What's interesting is that small caps are only 5% off the bottom from a year ago. US banks are down 18%. That's kind of a red flag. Why are banks down 18%? And we can go through all the reasons, anecdotal analytics as to why they're down 18%. But from a stock market symptom standpoint, that's not a great symptom. The bank shouldn't be down 18% from the lows of a year ago. That's not good. So we want to be really mindful of that. We want to be really careful about trying to chase the banks or, trying to chase the riskiest pockets of the market, and be more focused on the areas of the market that are working, that are dominant, and try to ignore these other areas for the time being. And, one area we've seen a bit of a chase in, of course, is the top of the market, where people have been chasing safety. So the FANG stocks, Facebook, Apple, Netflix, Google, NVIDIA, Meta, these are the areas, Tesla, NVIDIA, like these are the areas that people have been chasing into. And the number one thing we hear back from clients is like, well, they're great companies. They got a lot of cash on their balance sheets. They're $1 trillion market cap. They're safe. And we always have to remember there's no such thing as a safe stock. If it's a private enterprise, it can be disruptive. And we got to be really, really mindful of that. Remember, it was just a year ago that the Magnificent Seven, right? These FANG stocks, Apple, Netflix, Google, Tesla, NVIDIA, they were down more than 50% as a group in 2022. Facebook was down 70%. So we got to be really mindful. Like, you can be a great company, but a bad stock. The stock and the company, in many cases, are not the same thing. You can have a bad company and a great stock if the stock is underpriced. So we just want to be really, really careful of chasing the top of the market here. The other thing is bond yields continue to pull back into this breakout point. We had a big, strong breakout off of a base. Our target remains 5.25 on the 10-year. What we've seen in the last week is those yields were overbought. We're pulling back into this breakout point. We think that this is the next, this is working off an overbought condition before we resume north of 5%. That's our base case right now. And if that's what happens, and we want to say what works in a rising interest rate environment where inflation remains stubborn. Well, going back to the chart that we used the last couple of weeks, energy, energy, energy. We know the banks have some hair on them, right? Relative strength is continuing to deteriorate and fall. They had good earnings last week. We'll see if there's follow through on that. But the sector that historically does the best during times of rising rates and is acting well today is energy. This green bar way over here to the right. Materials have been acting well too. So again, these are the areas that we want to focus on where the fundamentals and the quant factors align. Energy, fundamentals, we're going to go through that in a second, are improving and fantastic in our opinion. And the quant factors align. With banks, the quant factors are there, but the fundamentals aren't, right? So we just want to be really careful in terms of how we determine what we're buying and when we're buying it. So why are we bullish on energy? Inventories keep dropping. They dropped again last week. Those cushion inventories has continued to fall. Demand for oil continues to grow, both stateside, despite all this chase into the green movement, demand for oil is going up. It's going up in the US, it's going up in China, and it's going up in India. Those are the three countries that matter. Everything else is noise. The major swing supplier is the Middle East. Well, what's going on over there right now? You got major geopolitical risk. One of the prime bear thesis that Iran's coming online. Well, guess what? They might be going right back offline right now. And then, of course, there's a structural long-term lack of investment in the ground. And once that shale bubble burst in 2015, we've had almost 7 years where you haven't had serious investment into the ground. So the ability of the industry to respond rapidly to rising demand is not there. So you create this gap, this supply-demand gap that causes rising prices for the price of oil, especially West Texas Intermediate. That particular blend of oil is in particular shortfall. And then lastly, M&A. We saw Pioneer got bought out by Exxon last week. We think that's the beginning. We think we're going to see an M&A wave within the energy space. And energy has responded well to the pullback. We saw a big pullback here. Oil went from about 93, 94 all the way down to 82 and then right back, right? And we saw the XLE respond very well. We saw the underlying stocks that we own respond quite well. And this is very indicative of a dominant bull trend. Dominant trend, as we hear the chart on the top left, you get a quick, rapid descent where the percent of stocks above the 50-day moving average move into oversold territory. That is a buyable dip as represented here, and then a bounce back and resuming that bull trend. Energy versus the consumer. Again, these charts intuitively obviously make a lot of sense. When energy and oil are rising in price, that's not good for the consumer because you're spending more at the pump and there are less dollars available to spend at the store, right? So U.S. consumer discretionary stocks relative to energy continue to make new lows. If this was a stock chart, this would be a shortable chart. Same with European consumer stocks relative to energy. So summary here, let the market guide you. Use the market as a barometer of risk. Don't fight the symptoms, embrace trends. So right now, the events in the Middle East are definitely scary. But it also reminds us of how important oil is to our economy. We're not phasing it out anytime soon. Number two, the S&P 500 bounce that we experienced about a week ago, pretty tepid, low volume, low breadth. Now we're approaching resistance points. Act with some caution in those riskier pockets, that especially the areas that we're not in right now, such as the banks, high price, high PE tech, consumer staples, utilities, REITs. Those are areas we want to be careful of, especially in a rising rate environment. And then lastly, energy is that one sector that historically performs pretty well during times of high inflation, geopolitical crises, and surging emerging markets growth. So that's what we got for you this week. 888-543-3776. Please feel free to reach out to your advisor. And if you have any questions, feel free to reach out. Thank you again and have a fantastic week.